All right, welcome to The Explainer. Today, we're diving into a question that's been bugging economists for, well, over a century. What really kills a bank? Is it that sudden, crazy stampede of depositors we see in the movies? Or is it something slower? A kind of hidden sickness that's been eating away at it for years?
So our guide on this journey is this really fascinating paper from the Federal Reserve Bank of New York. It's called Bank Failures, The Roles of Solvency and Liquidity, and it's by Sergio Correa, Stefan Luck, and Emil Werner. Now, they basically argue that if you want to understand financial crises, you have to get to the bottom of what causes a bank to fail. So they dug into all this historical data, and what they found was that failures are almost always tied to, just bad fundamentals, what they call solvency problems. They're saying that while bank runs get all the headlines, they almost never take down a strong bank. Instead, a run is usually just the final push for a bank that was already, for all intents and purposes, insolvent.
So yeah, that's the big mystery we're unpacking. When a bank goes under, what are we actually seeing? Is it the last act of a really long, slow drama, a bank that's been secretly sick for years? Or is it more like a tragedy, a perfectly healthy bank just getting trampled in a sudden, senseless panic? Okay, so here's how we're going to crack this case. We're going to follow the paper's investigation pretty much step by step. We'll start with the big debate itself, then we'll look at the tools the researchers used. After that, we'll dig into two huge clues they found. And then finally, we'll get to the verdict and talk about why all of this really, really matters for keeping our banking system safe today. All right, first up, the great banking debate. Let's get right to the heart of this thing. This isn't just some dusty academic argument. It's about two completely different ways of looking at how banking works. And it really all boils down to one simple difference, being flat out broke versus just being short on cash. So let's meet our two key suspects here. First, we've got solvency. A bank is insolvent when its assets, its loans, its investments, are worth less than what it owes to its depositors. It's fundamentally broke. The math just doesn't work anymore. Then you have illiquidity. Now that's different. An illiquid bank could have tons of valuable assets, like mortgages that are being paid on time. The problem is, it just doesn't have enough cold, hard cash on hand to deal with a sudden rush of people wanting their money right now. And this slide just lays it out perfectly. These are the two nightmares that keep bankers up at night. On one side, you've got the solvency problem. The bank is already a goner, it just might not know it yet. On the other side, you've got the liquidity problem. A perfectly healthy bank gets taken down by pure, irrational panic. So the billion-dollar question is, which one is the real killer in most bank failures? Okay, so how did the authors actually figure this out? Well, they couldn't just guess. They had to get their hands dirty and dig through a mountain of historical evidence. And believe me, they brought some serious tools to the job. The sheer scale of this research is just incredible. First, they built a simple theoretical model to help them tell the difference between a failure caused by insolvency and one caused by a run on a weak but still solvent bank. Then, and this is the amazing part, they applied that model to this massive new data set they put together. We're talking 160 years of U.S. banking history, with data on over 5,000 individual bank failures. This let them look at everything: failures before the FDIC, during the Great Depression, and right up into our modern era. It's a huge sample. So the first thing they did with all that data was to follow the money. They decided to look at the financials of these banks for years before they actually collapsed, just to see if there were any red flags. And this leads to a really fundamental question, right? If these bank runs are just random bolts from the blue, they should hit strong banks and weak banks pretty much equally. But is that what the data actually shows? Let's see. Well, the evidence is just crystal clear. A bank failure is almost never a sudden heart attack. It's a long, slow disease. The paper finds that banks that fail are almost always showing obvious signs of sickness, of fundamental weakness, way before they actually go under. And here are the specific symptoms of that sickness. The data shows that even 5 years before they failed, these banks were already in trouble. They had less capital cushioning them, they were making less money, and they had a growing pile of bad loans. They were even scrambling for more expensive funding just to keep the lights on. And get this isn't just a modern problem. This same exact pattern shows up across the entire 160-year history they studied. But here's the real kicker. The researchers split the failed banks into two piles, the ones that died because of a classic bank run and the ones that just quietly failed without one. And what they find? The pattern of that slow 5-year decay was nearly identical for both groups. Think about what that means. Runs aren't just randomly picking off healthy banks. They seem to be the thing that gives a final push to banks that are already teetering on the edge of a cliff.
Okay, so that was clue number one. Clue number two comes from the post-mortem. The researchers basically asked, okay, after the bank has failed and all the chaos has died down, what was actually left? The answer tells you a whole lot about how healthy that bank really was to begin with. And this number, wow, 75%. Think about that. Before we had deposit insurance, when a bank failed, its creditors, the people it owed money to, only got back about 75 cents for every dollar they were owed. That means a quarter of the bank's supposed value just poof, vanished into thin air. That is a textbook sign of insolvency. The assets on the books simply weren't worth what the bank was claiming. And this table here, it drills down even deeper. Now, if the theory that runs kill healthy banks was true, you'd expect those banks to have higher recovery rates, right? Because they'd have good assets to sell off. But the data shows the exact opposite. Banks that failed after a big run had even lower recovery rates, just 72%. It's another piece of evidence suggesting that runs don't just happen to any bank, they happen to the absolute weakest of the weak.
And it's not just about the numbers. The paper also brings in what you could call expert testimony from the people who were actually there. Here's a quote from the Federal Reserve all the way back in 1936, looking back at all the bank failures they just lived through. And they were totally unambiguous about it. They said, most of the institutions which suspended business were subsequently proved to be insolvent. They were blaming bad loans and poor assets, not depositor panic. Okay, so we've looked at the money trail before the failure. We've done the post-mortem. After digging through 160 years of evidence, what's the final verdict in this great banking debate? The verdict is in, and it's pretty decisive. Insolvency is the root cause. For a bank to even be at risk of failing, it has to be fundamentally weak because of bad assets. Those dramatic bank runs, they're the trigger, not the cause. They speed up the inevitable failure of a bank that was already insolvent. And as for healthy banks, they rarely, if ever, fail just because of a run. The paper shows that strong banks have all sorts of ways to survive a panic, even without a government bailout. All right, so we've solved this historical whodunit, but so what? Why does any of this matter for us today? Well, because if you don't correctly diagnose the disease, you can't possibly find the right cure. And this slide just lays out the stakes perfectly. If you think the problem is just a lack of cash, illiquidity, then the solution is pretty straightforward. You just have the central bank provide emergency cash during a panic. But if the root problem is actually insolvency, like this paper so strongly suggests, then just throwing cash at the problem is like putting a tiny Band-Aid on a massive wound. It won't work. The real solution has to be about making sure banks are strong and well capitalized to begin with so they can withstand shocks. So I want to leave you with this really interesting question the paper brings up. They talk about how historically sleepy depositors, people who were slow to pull their money out, actually gave weak banks a little bit of breathing room. But think about our world today. An age of instant information, Twitter, digital banking, a bank run can literally start and finish in a matter of minutes. So the question is, who are the sleepy depositors of today? Does anyone stay asleep for long anymore? And what does that mean for the future of financial stability? It's definitely something to think about. Thanks for joining us for this explainer.